In the fast-paced world of trading, having an edge is what separates the pros from the amateurs. And right now, one concept is dominating the conversation: multi-timeframe analysis. By combining different time horizons, traders are finding more reliable entry points and reducing risk. Today, I'll break down the strategy, walk you through the parameters, and share the backtesting results that'll make you wonder how you ever traded without it. So, what is multi-timeframe analysis? Simply put, it's the art of combining multiple time frames to form a single trading signal. By looking at a stock's short-term and long-term trends, you can identify potential entry points that are more likely to succeed. For example, let's say you're trading Tesla, and you're looking at a 15-minute chart. You might see a bullish trend, but without context, it's hard to know if it's just a minor blip or the start of something bigger. That's where a 4-hour chart comes in. If the 4-hour chart is also trending upwards, it increases the likelihood of a successful